Welcome to the MSCW podcast. I'm Jason Gumpert, editor at MS Dynamics World. On this episode, we are talking about 2026 tax changes with Scott Peterson, Avalara's VP of Government Relations. Tax changes are nothing new, and Avalara, the sponsor of this episode, has captured them in their newest tax changes report, which is available now, and we will have a link to that in this episode's show notes. The report aims to identify major themes, and this year that includes what Scott calls off-the-charts levels of change in terms of transaction taxes in the U.S. At the federal level, income tax changes have a direct impact on state income taxes, and Scott explains how states will react based on their own funding needs. And we discuss why states are expanding their sales tax base into digital goods and services, including taxing digital equivalents and B2B services. Scott also shares his guidance on the role of AI in international tax compliance and what else our listeners can take away from this year's report. All right, I am here with Scott Peterson of Avalara. Scott, welcome to the podcast. Can you tell our listeners a bit about your role and what you've been working on?
Thank you. Hi, Jason. Appreciate you guys giving us this chance. So my name's Scott Peterson, and I'm Vice President of Government Relations for Avalara. Avalara is a sales tax, transaction tax automation company. We're in the business of helping retailers, wholesalers, manufacturers, importers, hotels, B&B owners, tobacco companies manage their transaction tax compliance obligations imposed upon them by governments. And as a government relations guy, my job is to build relationships with our government partners so that if something changes on their end or on our end or something doesn't go right, I have someone that I can reach out to instantly and accelerate the resolution of the issue.
All right. Very interesting. I mean, these are policies that do change over time. And obviously, it's something that the Avalara team is known for keeping a very close eye on. And you document that in the Avalara tax changes report that the company has published over the years. Can we start out by talking about what some of the major themes or shifts are that stand out in this year's guide?
Over the years, the guide has changed when Avalara has gotten into a new tax type. For the longest time, we didn't do lodging taxes. So we started doing lodging taxes, and then we changed the tax report to include what's going on in lodging. We never had a 1099 company. We're in the 1099 business now, so we started adding that. So historically, the changes that we've made have been around the way that Avalara has changed. The broader we became in the sense that the more tax types that we help people manage, that was the primary reason for any changes in the tax report. It's usually easy to find things to talk about. The governments, that means, there's so many of them. I mean, we do business in all 50 states, DC, Puerto Rico, and all of Europe, all of Southeast Asia. We're just about I don't know if we do China or Russia, but we're just about everywhere else. There's always something that somebody's doing that imposes a new burden or changes an existing burden on a business. And so it's always been easy to find things to talk about. The challenge, honestly, is to not create an encyclopedia every time we publish one of these things, because there are so many things to talk about. So we try to look for the major themes. Is there some new idea that's sweeping the US or sweeping Europe? Is there some court case that is just so radical that it's going to eventually change everything that everybody does? So we look for those things, first of all. We look for things that most people have probably heard about, even if they don't know anything about Avalara or they're not in the business that we can provide help for, so that it's there's some value in it for somebody that honestly doesn't know anything about taxes. And we have shared this over the years with friends and family that aren't in the business, and they think it's fascinating because they, our prime writer Gail Cole does such a great job of trying to make this understandable to someone who doesn't know anything about tax, and yet valuable for somebody that does know something about tax. 25 was a crazy busy year here in the United States. Outside the US, things were pretty calm. other than tariffs. But from a tax perspective, a transaction tax perspective specifically, 25 was off the charts. Enormous changes in four different states. Truly enormous changes in order of states. There's always some change in every state. But in this case, we had there's one little change here, or a little change there in every state. And then 4 states just did radically massive changes. So we had a difficult time actually figuring out, making sure that there was enough space for all the other stuff, given how much we had to say about the 4 states that made radical changes.
Yeah. How has the federal level One Big Beautiful Bill Act of 2025 influenced some of those state level tax policies heading into this year?
First, it's changed state, corporate, and personal income taxes. One of the things that I don't think the average person has an appreciation for, because I've never had to care, is that almost every state in the country uses some definition on the federal income tax return as a starting place for the state income tax return. And that's the case both at the corporate level and at the personal level. So it's whether it's adjusted gross income or taxable income. And so when the federal government changes in a way that changes the meaning of federal taxable income or federal adjusted gross income, it automatically impacts every state income tax. Then the states have to go through this process of deciding whether or not they want to go along with the federal changes. It's always been kind of a working plan that the state income taxes would mirror the federal income taxes to the extent that's physically possible. But Wyoming is not the United States, and California is not the United States. So when the United States makes a change that applies to one branch of government, their United States branch of government, it doesn't necessarily reflect the economic circumstances of each individual state. We have a national economy. Arguably, each state has their own economy, but most certainly each state is made up of multiple economies. Therefore, a change that's made at the federal level that's very positive for taxpayers may be just overwhelmingly devastating for some states' budget. Federal government doesn't have to balance its budget. Every state in the United States balances its budget. So when Congress changes something, like they did with the One Big Beautiful Bill Act, which was to reduce the amount of taxes that businesses and individuals pay, any state whose personal and corporate income tax was tied in some way to that number that got reduced at the federal level, automatically reduced that number at the state level. And when you reduce, so the federal government's going to collect less taxes, that automatically means that every state collects less taxes, unless they choose otherwise. So one of the big things that we're watching today is all of these states going through this process of deciding whether or not they can afford to do the same kind of tax reductions or tax changes at the state level that the federal government did at the federal level. That's the first thing. The second thing is that part of the One Big Beautiful Bill Act affected 2 major programs that are run by states, federally funded, state operated, and that is SNAP, which was formerly called food stamps, now called SNAP, and then Medicaid. SNAP was always 100% federally funded, 100% state operated. Medicaid is a mix of state and federal funding, but state operated. And the federal government in the One Big Beautiful Bill Act reduced the federal share of both those. So you have this situation where the federal government's income tax changes are going to reduce state income tax changes unless the states take some action to stop that. And while at the same time, there's a greater obligation on the states to pick up the funding that the federal government has reduced in Medicaid and SNAP.
So yeah, I can sort of see how you're painting a picture of a cascade of changes, perhaps. Can you talk about the growing trend of states expanding their sales tax base, especially when it comes to digital or B2B services?
There's 2 themes, and these have been playing out for a long time. The first thing is that you and I, we don't consume the same way we used to consume. We don't consume the same way our parents consumed, because there are things that exist today that didn't exist when our parents were consumers. And that is specifically at services. A greater percentage of what you and I spend today is on services than it is on tangible personal property. And historically, that change has reduced the amount of consumed things that are subject to sales tax. And they're just natural because of the way the sales tax was created. When it was first created, and for the very, very long time, and in some states still completely today, the tax is imposed on tangible personal property. Tangible personal property is a laptop. It's a water glass. It's a table. It's a desk. It's a car. It's things that you can see, feel, touch, or in some other way experience. And as you and I spend more money, we don't buy records anymore. We listen to some streaming music. We don't buy physical books. We get a digital book. No, not even a digital book. I mean, my wife uses a streaming book service. So she's not even getting a book. When she pays $16.95 a month to listen to an unlimited number of books that, I'm glad she's not buying, and because it would fill our house up. But that didn't exist when our parents were consumers. My parents were consumers. So when they wanted to buy a book, when they wanted to read, they had to go out and buy a book. Well, a book's tangible. So a book was taxable. So as the economy, even if the economy had stayed flat, because it switched from tangible personal property to services, there's this natural reduction in what is taxable inside the states. So that's the first theme. States are out there looking at that thinking, the amount of money that I should be collecting for my sales tax based upon the amount of money that gets spent in the state is radically different than it used to be, or radically different than it should be, because I don't tax services. So there's this big movement for a lot of years to start to tax services. And it's happened a little bit, but honestly, it hasn't happened very much. Kentucky and Iowa in the last 5 years have done a pretty major expansion of their sales tax to just run-of-the-mill services, dry cleaning, movie theaters, that kind of stuff. But there hasn't been any big groundswell of changes for that type of thing. But people talk about it every year. I guarantee you there's some state legislator at this very moment talking about the fact that his or her state should tax services. It's often tied together with a reduction in some of the tax. So when you read articles about states wanting to get rid of their income taxes, in that article will be some mention of expanding the sales tax to services to collect more money from the sales tax so they have money so that they can afford to reduce their personal corporate income tax. The second theme is around things that are very clearly alternatives to things that were tangible. So I talked about books. Well, my wife's streaming service. So you can get books 3 different ways. You can go to the bookstore, you can buy a book. You can go to a electronic bookstore and you can buy and download a book. In both those cases, you get a book. The third way is to do a streaming service where someone reads a book to you. And that is very different from the other two because you don't actually possess anything. You don't actually own a book. You just pay $16.95 a month to listen to books. So what states are targeting, and a lot more states have done this, is that the distinction between the physical book, owning a physical book and owning a digital book. And states are saying, if someone buys a book and they're buying a book and they're keeping a book, they should pay the same sales tax. They should both be subject to sales tax. My wife's situation where she has this service, that's kind of the former conversation. This is something that didn't exist, 25 years ago, and is completely different than owning a book. So we're seeing a lot more states that are going through and looking at the things that they tax on a tangible format that are also available in a digital format, and then expanding their sales tax to the digital sides of that. Things that are, in the phrase of their use, or things that are delivered electronically, accessed remotely. And usually there's some sort of a trigger in there, whether or not it's for permanent use or not for permanent use, because states are more likely to tax something that's for permanent use, like a digital book versus a hardcover book, unlike a service where somebody reads a book to you.
Yeah, I can certainly see why states are paying attention to digital services. And, we'd mentioned B2B services as well. What are the implications for businesses operating in states where there's a focus on that?
This has been probably the reason why there hasn't been a large number of states that have moved to taxing services. There's a clear list of services out there that you and I as consumers buy. It's a shocking number of states that don't tax them. Dry cleaning services. There's hardly a business out there that spends a lot of money in dry cleaning services. People spend money in dry cleaning services. Individuals do. And if you're going to have a sales tax, you go to a law school and have somebody teach you what a tax structure look like and what a sales tax should look like. They're going to say it should apply to the ultimate consumption of things purchased by consumers. And it shouldn't apply to purchases by businesses to the extent that that business is going to use that thing to build something else that's subject to sales tax. This has been where most of these conversations at the state level have died, because if taxing dry cleaning, taxing movie theaters, taxing entry to concerts, those type of things are all ultimate consumer purchases. And in an ideal, sales tax should be subject to sales tax. What often gets brought up are big ticket business purchases. And that's what happened last in 2025 in Maryland and Washington. I don't want to say to their credit, but at least they were honest when they said this, that they picked services that they were going to subject to the state sales tax that are specifically purchased by businesses. So they threw out the economic purity of having a sales tax of final consumption and picked services that were going to most certainly are almost exclusively purchased by businesses. And they're not the kind of thing that you and I as consumers would ever buy. A lot of the marketing stuff. And right off, I can't give you an example of them, but there's the Washington one in particular. They had a very clear, long list of marketing services that are now subject to their sales tax that you and I as consumers would never buy. You know, they're kind of things that a business buys to literally market itself or to measure how well it's marketing. And I looked at the list and I thought, okay, well, I'm glad you titled this legislation an act to impose tax on business purchases, because that's exactly what you did. Maryland was a little broader. They taxed a lot of services, not a lot of ultimate consumption services. They're all business purchase services, but there are a wider variety of business, mostly in the software services space. Yeah, this was an odd year for that, because those two states very specifically targeted purchases by businesses and were open and honest about the fact that that's what they were doing. Historically, when there's a piece of legislation that's introduced to broadly tax services, it's the accounting industry and the legal industry that come in and say, no one buys us except businesses. You want to tax consumers, fine. Tax dry cleaning. But if you tax accounting, there are some, yes, I prepare income tax returns for some individual clients. Yep. Okay, let's figure out a way for you to impose a tax on that type of service. But the lion's share of the money that I make is for accounting services and consulting services to large businesses. And all you're doing is adding to the cost of the product that they manufacture that's going to be subject to sales tax at some point in time in the future.
Well, let's change the topic a little bit and talk about audits and compliance scrutiny. Is there a possibility of audits and compliance requirements going up in 2026? And if so, how should businesses prepare?
Two things. The first is technology. As businesses incorporate artificial intelligence in their business, states are doing the same. So states are going to are taking the utility that comes with some of the artificial intelligence tools to maybe broaden, but certainly speed up the analysis that they have. I ran South Dakota sales tax for 10 years. And our audit division, when they went out and audited somebody, it was just a crapshoot, whether or not they'd walk into a business that was fully compliant or not compliant at all, because they didn't have any data. You couldn't find data. You couldn't buy it. It just didn't exist. And that has changed. People now are in the business of selling data. Everybody's in the business of selling data. So it's easy to find data today. Credit card companies sell it. Everybody sells it. The challenge is that it is enormous. There is so much data out there that the states have never been able to really get their hands on the value of that data. Artificial intelligence is going to change that. And that's the conversations I hear states having, is that they're able now to radically accelerate the analysis of the data that they have and be very focused and pointed in the auditing that they do. If you're an auditor, the last thing you want to do is walk into some small business who does absolutely everything right, because you're just wasting their time. Are they happy when you leave and you tell them that they're doing a great job? Sure they are. But they spent 2 weeks of their life trying to prove to you they were doing the right thing. And that moment in time when you're telling them they did a good job, they're happy. But as soon as you leave, they're going to say, why in the world did I spend 2 weeks proving to you that I was right? You should have just asked me. State will hopefully, in their mind, hopefully is on their side of this, be able to avoid that kind of a situation in the future. Because what AI will give them is the analytical capacity to find anomalies that they might not have been able to see before. Just like artificial intelligence is being used in the medical field to look for anomalies, they'll be able to do that at the state in the data that they're able to buy. The second thing is we're about to go into a period of time when there's less tax collection. Things are going right. Honestly, most states are doing relatively well right now, but that's going to change. And it's already started to change. The governor of Alaska last week, introduced a sales tax legislation in Alaska. We're going to start to see other states talk about how to balance their budget. And they haven't really had to do that in the last 3 or 4 years. There's been so much federal money involved. And then, the economy has been doing kind of remarkably well, so that there's not been a shortage of money. That's going to change. And when that changes, one of the things that states do is go to the Department of Revenue and say, okay, what would we have to give you to do more audits, especially out-of-state audits, and especially internet retailers. What's one of the things that's changed in the last few years is, the Wayfair versus South Dakota Supreme Court decision. There are a lot more retailers collecting sales tax today than there has ever been. And every state now has a lot more retailers, and they're not hardly a single state expanded their audit capacity after the Wayfair decision. A couple did, Wisconsin and in either Minnesota or Washington, but almost no one else did. And that's because the money's been coming in and they haven't had to think about that. Now that the money is starting to get short, they'll go to the audit division and say, okay, how many auditors do you need? And can you focus only on, say, retailers?
All right. And when we talk about compliance as it relates to managing multiple points of use for digital goods, what are some of the challenges in that area?
In theory, there shouldn't be any challenges at all. It should be a perfectly suitable tool for folks who are buying something that's digital or something that can be used by multiple people in multiple locations at exactly the same time. The concept of a multiple points of use is really kind of old. Historically, 100% of the obligation to remit sales tax is imposed upon the seller. So the seller has the legal obligation in every state to collect the tax. They don't get the choice. They've never been able to push it off to the retailer to remit their own taxes. If you have a sales tax license in the state, you are legally required to collect the tax, and you're legally liable for all the tax that doesn't get collected. When software became widely used and widely available, when laptops were invented, frankly, and there were laptops all around the United States with software on them, it occurred to the retailer of that laptop that they couldn't possibly know where that laptop was at any given period of time. And maybe that's changed today, but in those days you couldn't. And so it was impossible for the retailer to collect the right tax because the retailer didn't know where the consumer was going to put that laptop. So your company ABC, and you have 1,000 employees, and you're going to replace all the laptops with all the software that goes on it. Those laptops are going to be shipped to company headquarters. So the retailer is going to charge sales tax on the sale of laptops to the company headquarters. Well, at the company headquarters, They're going to put their own security in. They're going to do their thing to those things. Then they're going to ship them out to their 1,000 employees around the United States. And then thereafter, there's going to be a monthly maintenance fee on each of those laptops, and then a monthly subscription to all the software on those laptops. At that moment in time, that laptop is taxable in the state where the employee is using it and not at the corporate headquarters. So you're that retailer, you're the person who sold them the laptops with all the software, and you now have an obligation to collect sales tax on that monthly subscription or maintenance fee based upon where that computer is actually being used, and you don't have a clue. So the multiple points of use document, it's an exemption certificate, was created so that the buyer could give to the seller this thing called a multiple points of use certificate and tell the retailer that you don't have to worry about the sales tax. We're going to pay use tax based upon where we're using the laptops and the software that's on those laptops. Something that is purchased by one person, corporate headquarters, that is used in multiple points at the same time. It's an ideal concept. And it's always frustrated me in all the years that I've been doing tax policy. It's always frustrated me that so few states are willing to accept these things as a legitimate tool to allow the correct collection of tax. Because if your headquarters is in Montana, there's no sales tax. You had those 1,000 laptops shipped to Montana, there's no sales tax collected at all. What happens after that is where the retailer gets in trouble, because the consumer, the ABC company ships those laptops off. They don't tell retailer A or the retailer where those laptops are headquartered. And then some state goes in there and they audits ABC company in Montana, and they find that those laptops are being used in California and Texas and all over the United States. And they don't go to the company they're auditing. They go to the company that's charging for the monthly subscriptions, and they make them pay sales tax based upon where those things were used, and they had no idea what was happening. I talked to a lady a couple of years ago. She was headquartered in Washington, and she was buying a bunch of software for a manufacturing plant she had in Louisiana. Washington taxed it. Louisiana didn't tax it. She couldn't get the retailer to accept an exemption certificate for that purchase, and she ended up paying Washington sales tax on a product that was used exclusively in Louisiana. You know, it's just plain wrong. A complete mess up of what the sales tax system is supposed to be. Sales tax is supposed to be a tax that's imposed upon where someone is using the product. Point of sale is a proxy for use, because there's no way you can force a retailer to follow along the chain of use where a product or service is used. I mean, we tax haircuts based upon where the haircut was given, even though it's used for a month. You know, I use my haircut every day for a month, and then I go back and get a new one. Well, we couldn't expect the lady that cuts my hair to apportion, you know, the 35, I don't have much hair, to apportion the $35 she charges me to cut my hair over the 30 days that I have used that haircut, because she has no idea where I am. So we use where she is as the proxy for use. Well, there's lots of times when we know where the actual use is. And software is a very good example of that. They know exactly where the employee is the day that that software is being used.
Really interesting scenario, and one I think certainly our listeners can take to heart and probably consider carefully. And I know you discussed that in the guide. Another one is, well, going back to something that you talked about earlier, which is, you know, states considering new approaches to tax policy in response to budget pressures, perhaps some of them caused by some of the policy shifts we talked about earlier, maybe some others. Can you talk more about some of those new approaches?
I'll start off with the worst. Well, worst is I'll start off with the one that's the most complicated. A concept that was created based upon something that is universal inside the United States. And that is the way we fund highways doesn't correlate directly to the use of those highways like it used to. In the old days, when there was no such thing as electric vehicles, or when there was no such thing as fuel-efficient cars, the way we fund highways, which is taxes on fuel and taxes on registration, those two things did a fairly good job of representing the actual use of the roadways. The invention of fuel-efficient vehicles and the invention of electric vehicles just decimated the correlation between use and taxes. Because highways are one of the few things in the United States that are supposed to be paid for by user fees. You and I, we drive a mile, we've used X amount of fuel to do that, and we pay X amount of money on tax on that fuel. Though that is supposed to represent our use of the road for that mile. The highway trust funds, and every state has some way of dedicating the revenue that comes from fuel taxes and vehicle registrations, and they put it in a trust fund, and the trust funds is what they use to pay for highway maintenance. And then the federal government does the same thing. They have their same licensing and fuel, and it goes into the federal highway trust fund, and that gets distributed out to the states who use it to fund and pay for the federal highway system. The funds have not kept up with the cost of maintenance. They have not kept up with the cost of construction, and they have not kept up with the increase in the number of vehicles that are using them. It's easy to say it's electric vehicles and fuel efficient vehicles, but it's probably more than that. The cost of building, the cost of maintaining is going up. Gas taxes never go up. An unbelievably odd time when a state increases this gas tax, although we see it, and it's not a partisan issue. I've seen both Democrat and Republican states increase their motor fuel taxes, increase the annual license fees. It's a function of, I've got X amount of road, and I don't have enough money to maintain X amount of road. So somebody in Colorado thought, what we need to do is get those people out there driving those trucks around, dropping off packages. They're the one, that's the real change in who's using our highways, all these packages that are being delivered. And so they came up with this idea of imposing a fee every time a package is delivered. And so they worked this out. It started in Colorado, and it's called the Colorado Retail Delivery Fee. It is a combination of 5 fees that go in to make it up the one fee, and the 5 state agencies use a portion of the total fee to pay for some transportation related cost. I wouldn't always say it's highways, it's transportation related. But the people who wrote that legislation had never imposed a tax on anybody before. And it never occurred to them just how hard this might be. So it's what is it, right? I think it's 28 cents. 28 cents. And imagine this, I saw the legislation, and I thought to myself, okay, well, I think I understand, but it doesn't make any sense to me. Then I thought to myself, how am I going to go in there in front of the Colorado legislature and argue against this piece of legislation that all it does is impose a 28-cent fee every time you deliver something to somebody? And that's really where people got stuck. They couldn't find a legitimate lobbying argument against this until they got lucky and they realized how hard it is to do. And so in Colorado's case, they have a very strange sales tax system. The state system is completely separate and divorced from the local system. Locals tax many more products and services than the state does. So for the state to impose this tax, they had to impose it on the things that the state taxes. So first of all, if you make a sale to someone in Colorado and you're going to deliver a product to them, if it's subject to the state sales tax, you have to charge them this 28-cent fee. You have to put the fee on the invoice. It's got to be a line on the invoice that said Colorado Retail Delivery Fee. And then every month, you have to file a separate tax return with the state of Colorado to report that fee. Very quickly, it didn't occur. Very quickly, it dawned on people, I don't own my invoicing system. I use ABC Company's invoicing system, and I can't just make changes to their invoicing system. I got to get their permission to make changes to their invoicing system. So I got to call my rep at the invoicing company and say, I need to be able to add another line on the invoice, and it's got to be this, and it's got to be something I can do under these conditions. Not every condition, under these conditions. So first of all, no one had the capacity to put this on the invoice. Second, this extra return. I mean, people were going out there and they were charging, $35 in retail delivery fees in a month, and then having to pay their accountant $150 to file that return that had $35 on. It was just a nightmare. And we all thought this thing would go away. It never went away. Minnesota did the same thing. They made theirs worse. This thing is constantly talked about in the state legislatures because every state in the country is short of highway funding money. And we've seen at least 8 or 9 pieces of legislation in so far this year. And that's just so far. I mean, most state legislators have only been working for 2 weeks. So we're just getting started and seeing what is and what isn't going to be introduced. These things are very complicated. So that is the long story, but that is a trend that we're watching. That's a really hard trend. It's hard for us to implement them. We took us a while to figure out how to do that for our customers. We pay very special attention to that type of legislation now. We're not afraid to call state legislators now and say, no, I don't think that works.
Yeah, these new complexities and perhaps unintended consequences that legislators can't imagine or just don't see.
Part of the way that a tax structure works, that it is bifurcated. That's trifurcated. There are three players in almost every tax anywhere in the world. There's the government that imposes the tax. There's the consumer or the earner who is the ultimate payer of the tax. Then there's that person in the middle. That person in the middle who's actually doing the administration. So for sales taxes in the United States, value-added taxes outside the United States, the person who is doing the actual work is a business. There's almost no taxes that exist in the United States the government actually collects. The overwhelming number of taxes, and certainly the overwhelming amount of taxes, are collected by a business, either in sales tax, withholding taxes for income tax purposes. I mean, the lion's share of income taxes, personal income taxes paid in the United States, both at the state and federal level, are withheld from the employee's wages by the employer. By law, employers are required to do it. The employer is punished if they don't do it right. And the lion's share of property taxes are paid by the mortgage holder. It comes out of your monthly mortgage payment. A part of that is principal, interest, property taxes, and insurance. And it's that mortgage holder that makes that annual or semi-annual payment to the county for your property taxes. So the overwhelming majority of taxes in the United States are actually administered by a business and not the government and not me. I mean, we don't even do our income tax. Somebody else does our income tax. So honestly, the only tax that I pay directly is when I license my vehicles. So twice a year, we have two cars. Twice a year, I go to the county and I write them a check for X amount of money to renew the sticker on my license plate. That's the only tax that I pay directly to the government. Every other tax that I pay goes through this third party, a business.
And before we let you go, just a couple more points coming out of this outlook that Avalara has. AI in the international tax compliance realm. What should U.S. businesses know about developments around the globe?
The part of the world that uses a value-added tax in lieu of a sales tax has long known that it's easy to commit fraud. It's based upon how the tax is reported to the government. And so their solution to that fraud is to standardize invoices. And at some point in time, in the not too distant future, every invoice that every business uses with another business in all of Europe and much of the Middle East and other places will be exactly the same. It will look exactly the same. And there will be some ways that you can personalize this for your particular company, but all the data is going to have to go in the same spot, going to look like the same thing. It's going to get transmitted from business to business in exactly the same way. It's called e-invoicing, electronic invoicing. And they're slow to implement this thing because, as you might imagine, there are hundreds of invoicing companies in the world, and you have to get all of them on board using up to speed on how to do these things. When that's done, and today this is happening in some countries, the invoice itself will go to the government. And then that's how the government will use that invoice as a way of either pre-auditing or post-auditing the tax return that you submit that invoice was part of. Artificial intelligence is going to radically accelerate the way governments use the data. Like I said earlier, with states, when the states do audits, the problem isn't today anyway, isn't the lack of data. It's a lack of computing power to actually understand the data. And the same thing will happen in the value-added tax space outside the United States, because the artificial intelligence will give them, just the additional computing capacity that goes along with that, will give these governments the real ability to look at an invoice and say, I've never seen that invoice before. There's something wrong with it. Let's stop this. Don't refund the money for the people who submitted that invoice to you because it's suspicious. It surprises me how often I read an article in the tax press about somebody in Europe finding and convicting, 12 people in 5 different countries for a massive, billion euro value-added tax fraud. And it's because they've created invoices that are fake and they submit them to the government and the government just pays them the money. That's all going to end. So anybody that's doing business, regardless of where they are, in areas of the world that use e-invoicing should expect to have to follow rules. The rest of the world is a lot better at enforcing cross-border transactions than the US has been over the years. You can't ship a product into the EU or any country in the EU without it going to customs, and customs in those countries make sure that the tax is collected. So that's the first thing. Electronic invoicing, electronic auditing, and maybe pre-auditing. There are countries that are going, this happens in Brazil today. In Brazil, in certain transactions, you cannot make a business sale to another business without the invoice first going to the government and getting a stamp on it, of some electronic stamp on it, so that that government knows that you're selling this thing to ABC Corporation, and it has to be done in advance. That will be the norm in the future outside the United States. I don't see that coming to the United States. I see invoicing come to the United States because it's actually a much more efficient way of transmitting invoices and getting a quicker way. It's more efficient and it's quicker. And if you can make the invoice processing simpler, you should be able to speed up the actual delivery of the goods and payment of the goods.
This is a topic that I certainly see continuing to come up as these standards evolve, since I do cover ERP and business systems and watching it come online in different countries. So interesting to hear your perspective on that one. And I would certainly say it seems like the kind of area where if you're in the US and it hasn't hit you yet, it's worth paying attention to.
Yeah, the large invoicing companies, they have to sell all over the world. So I presume that the multinational invoicing companies are going to have an e-invoice. It's going to be available for use for everybody anywhere. It's like cell phones. In the old days, if you took your phone with you to Europe on vacation, you'd have to take a transformer because you had to convert 220 to 110. Well, now it's just all built inside the device. Now you don't have to do that because it's built inside the device, because the people who made iPhones, the people who made laptops said, I can't make a laptop for Germany and then a separate laptop for France and then a separate one for the United States. I'm going to make a laptop that is universally capable of handling any kind of power you put in it.
Any other takeaways that you would hope that every business leader gets from reading this report?
These changes aren't well published by the governments. We're a 5,000 person company and there are lots of rules inside this company. But when it comes to tax changes, and we all live by one rule: if you see it, report it. We're like at the airport. You see something, say something, because it is so hard to keep up with all the changes. And they're not all at the state level. There's lots of local governments out there that have their own taxes. And whether it's property taxes or sales taxes or lodging taxes or meals and beverage taxes, personal income taxes, every county in Ohio has a personal income tax. The inability to keep up with change can be so daunting that what we're in the business of doing, and if we're in the business of doing it, and it's hard for us to do, if I was a business person out there, I'd be really, really cautious. I'd be very careful about where I was going, which is hard these days. The Wayfair decision from 2018 made everybody a taxpayer everywhere. It's not like the old days where you only needed to care about South Dakota sales tax if you were going to open a store in South Dakota. Otherwise, you didn't care. Never give a second thought to it. Now, because of the Wayfair decision, wherever you make sales drives what you have to know. Your next customer could be the one that took you over a economic nexus threshold in Wyoming, which means you had to instantly understand what make Wyoming different than all the other states that you were doing business in. that the lack of ability to keep up with all the changes going on, and that's just if you're a multi-state. If you're a multinational, multiply that times the 200 separate countries one could do business in.
Yeah, gaps in knowledge, gaps in tools. I mean, it's something that continues to evolve. It's always really interesting to hear the Avalara point of view, I guess you would say, and it's been great to have you on here to talk us through it, Scott. Thank you very much for your time today.
You're very welcome, Jason. It was my pleasure.
This has been another episode of the MSTW podcast. My thanks once again to Scott Peterson of Avalara for joining me. For more information, we will have a link to the report that we talked about in this episode. You can also get in touch with Avalara by email, microsoft@avalara.com. And that's it for this episode. If you want to get in touch with me, you can send me an email, jason@msdynamicsworld.com. For all of our updates, please do follow us on LinkedIn. Until next time, this is MS Dynamics World, signing off.